Welcome to the Foundry, where leaders are forged daily. I'm your host, George Roberts. Welcome back, investors. Today we have Sandhya Seshadri, founder of Multifamily for You. Welcome, Sandhya.
Thank you so much for having me on your show. It's a pleasure to be here, and I hope I can add value to your listeners.
Absolutely. I'd like to start by asking you, as an active investor in over 650 doors, tell us how you got your start in real estate.
If I could start a little bit before that, I have, like most Asians you might know, a background in electrical engineering, and I was working in corporate America, and I also got my business education through the same company by attending evening and weekend classes. So that's where I got my business knowledge. So I went from a technical role to a more business role and learned a lot about the stock market as well in that process. And so for over 2 decades now, I've been investing in the stock market. And as I had a family, had children, I wanted more of a lifestyle where the corporate America didn't dictate my hours. And so that's when I went full time into the stock market. Always wanted to do something with the real estate, but didn't want to deal with the 4 T's: tenants, toilets, trash, and termites. So, and I'm not a very handy person, didn't want to get a call on Thanksgiving dinner that said it was a leaky toilet. So I avoided the single family route completely. And when a friend told me about multifamily, where my investing can be more hands off in terms of not being called to do the day-to-day management that goes with rental properties, but instead I could be an asset manager, and a property management company can run the property for me, taking care of these day-to-day tasks, that's when I got interested. So I learned by first investing on the passive side, because it's like, before you want to run a restaurant on your own, you want to be eating and dining at a restaurant, understanding the customer experience, etc. So as a passive investor, you are the customer, right? So I started out passively. It's like once you've got your education through either books, mentoring programs, etc., you kind of want to dip your toe in the water by being a passive investor. You get monthly reports. And once you invest in a few deals passively, which is what I did, I'm actually now passively invested in 17 deals. What that did for me was to see the things I liked about good operators and what are some things I want to therefore pick and choose the best of what I liked and put them into my own when I started syndicating. So I syndicated my first deal in August of 2019, and it's been 2 years now. We've listed that property for sale, and all our passive investors are probably going to at least double their money. So very excited to complete a full cycle. And that's been my journey so far.
That is very exciting, completing a full cycle. That's something you don't always see with a lot of the operators today. Of course, we had a great recession. We had some very, very low prices for a while. For a while, it was enough to just buy right. And now you've really got to manage things right and understand the business, I think, a lot more deeply. So congratulations on that.
Thank
A
you.
lot of things I'd really like to highlight there is, starting passive. I think that's brilliant because a lot of people, I think, that are interested in being active investors, they look at passive investment and they say, like, yeah, but I'm active, I'm an entrepreneur. But I think you really do, or most people, I should say, I believe, are vastly underestimating how much you're going to learn as a passive investor.
Yeah, you learn so much because you do all of the, initial homework of the operator and make sure the property is in a good market. And I think that's quite a bit of a learning curve in itself. And then you get to watch and learn rather than having to take on all that liability yourself as a passive investor. What people don't realize is they think once they close a deal as an active investor, that the work is done. And truly, that's when the honeymoon is over and the real work begins. And so asset managers, especially COVID really highlighted who are the good asset managers focusing on, increasing the value of the property versus the ones who kind of hoped that the economy will basically appreciate the value of their property. They wouldn't really have to closely watch their expenses or focus on delinquencies and things like that. So asset management is not as easy and glamorous as people sound, because all you ever see posted on social media is, yay, we closed a deal. Well, what happens after you close the deal? How many people are talking about, oh my gosh, I just took over this property and half the stuff that I read in the OM is not true. I'm going to have to go back and redo all of these assumptions, et cetera, right? You never hear about all of that. And I think like once you're passive and you get these monthly reports, the things you find are very different, especially if you live close to that subject property and learn step by step rather than diving inside. I think of passive investing as like the internship phase. You don't really get paid much, but then you go in and you learn some, and then you're ready now to be the surgeon yourself, so to speak.
Yeah, I love that. That's fascinating. Other thing, dealing with this long time frame we'd had this great big expansion, huge, monstrously large expansion. As Warren Buffett says, you don't find out who's swimming naked until the tide goes out. So I think we will, as the next crisis and through this crisis, find out, which operators really know what they're doing. And then also you mentioned asset management. So that's an exciting thing to jump into. I think maybe with an engineering background, people might have predicted that you would go into the underwriting and that you'd love the spreadsheet end of things. So what drew you to you like that too? Okay, good. So then I suppose that acquisitions as well as asset management, you found yourself on both sides.
Oh yeah, I do all three pieces in my GP deals, whatever I do. So I have to underwrite it myself. So my first deal, I underwrote it independently. I went after it, I toured it. And then I found two other partners who are going after the same deal, and they were both out of state. So I kind of said, okay, let's combine forces instead of competing against each other in a bidding war. And so that's how the first deal happened. The second deal, I was actually invited by other partners who had already done the underwriting. And so it's very important for me to do my own independent analysis. So all my deals are in Dallas. That's where I've lived for over 30 years. So I drive the markets myself. I sit there and I say, okay, how does this property feel by day versus by night? Something that people don't really look into, but a place can completely change its whole mood and vibes when you go at night versus during the day. So I want to make sure it's a safe place. But underwriting involves also analyzing the comp properties. So you really need to know what's a true apples to apples comparison and what's published even in things like CoStar or other Yardi kind of reports are not exactly the same as when you're actually sitting in the leasing office of your comp property and walking that property with that leasing agent and getting to know what a true comp is, and not just in terms of the rents per square foot, but in terms of how much better or worse is this comp? What is my competitive advantage, or what's something I can learn from this comp that I can use in my property to increase its value? So I have to do all of that upfront work myself, even if someone else so-called did it. So I do all phases of the project.
That's excellent. And, I feel very strongly about that, even in something supposedly passive like the stock market. A lot of people, they look at stock picking like, oh yeah, I know the winners. But if you're not even looking at things like the financial statements, right? Definitely shouldn't be doing that. And I think probably everybody should be doing a lot more due diligence. I've heard it said that people will invest in a stock after less research than they would put into a refrigerator or other appliance purchase.
Yes, exactly. I always think of the amount of work goes into, car, appliance, etc. And I think you should put at least that amount of work into your stock picks, as well as analyzing your markets for multifamily. And if you're a passive investor, definitely vetting the operator is so important.
That's great. Yeah. And driving the property at night, I've invested in some areas that maybe not so nice, but if you can go by there on a Saturday night after dark and you still feel comfortable in the area, then, hey, maybe it's a go. Otherwise, you're not going to find a way to truly make that work. Beautiful. And so I just love, how you're highlighting the fact that multifamily truly is a team sport, and how you are in a certain sense able to be more passive than with something else, right? I mean, try that with single family homes. I mean, you've either got to be very close to the front lines, or you're giving up a large proportion of your profits. Well, everybody, I think, likes to talk about their most recent successes and how awesome they're doing now. But, just to fast forward back to that beginning. So your first deal, so you did find the deal yourself, you did the underwriting, you brought in two more experienced partners to help you run the deal. To get back to that mindset, I think a lot of people are at that point in our listenership, and they want to know, like, hey, what do I do? I like multifamily. I've educated myself. Maybe I've even found a deal. How do you go at approach a more experienced sponsor, somebody who's able to get you across the line?
I think it's very important to figure out what you have to offer and what you need from the experienced partner, right? Are you good at raising capital yourself? Or are you an underwriter? Or are you located on the zip code or area where the property is located and you're willing to do all the hard work while being directed by this experienced sponsor? So what are you looking from that experienced sponsor? Are you pretty wealthy yourself? You can provide all the liquidity, net worth, or things that you need to sign a loan. Or do you need a guarantor for your loan, right? So kind of spell out what I have or what I have to offer to a experienced sponsor and find someone with complementary skills. So for example, if this is your first deal and you've never managed a property before, then you want someone to help you once the deal is closed to run the property. Is that the most important thing for you? Do you want the resume of that more experienced sponsor along with you and their picture next to you so that when you pitch the deal to investors, they have confidence and they want to invest with you? Is that what you're looking for? Are you a pretty good underwriter? Are you willing to do all of the so-called dirty work, the running around kind of internship kind of work so that the main chief can direct you, but their time is freed up? So why should an experienced sponsor take you on? It's just like the interview question, right? Why should you hire me? It's the same thing. Why should an experienced sponsor take you on? What are you offering to them that they should spend their time with you over somebody else?
That is outstanding. And I hope that clears up a lot of confusion on the part of people who are sort of on the threshold and see that, maybe I could jump into a deal, but don't know how exactly. Find out where you can add value. And even if it's just your location, if you're the boots on the ground, that is absolutely huge, huge. Let's move on to some of your newer deals. Can you tell us some of the things that you've done since these first two?
Yeah, so my latest deal, we just closed it 3 weeks ago. We were all together on a bus tour. I'm part of a larger mentoring program. And we were on this bus tour where we have 5, 6 buses that drive around on one Saturday, visiting properties owned by people we know, and then some that are listed for sale. And we visited 2 properties together. This is 6 buses worth of people. Like you're talking almost 300 people visiting these properties. And there are these 2 gorgeous properties listed for sale. And my mentor announced, I want this property. I think I'm going to go buy this property, he said at one of the properties. So immediately I said, I'm not wasting another minute looking at that because I'm probably not going to get it. Even if I have a more competitive price, unfortunately, it is not a fair business. The brokers are going to give the deal to my mentor who runs, who has over 1,000 students and is very successful doing what he does. He's just at a different level than me. So he's going to probably get awarded that deal. So I went after the second deal, the other deal that we toured. It was a very similar property. It looked gorgeous, presented itself really well. And I knew that market very well because in the last 12 months prior, I had toured 4 other properties with the intention to maybe make an offer on them. So as soon as I saw the property, the location, I knew my comp properties, I went after it. That's all that I did. Like literally the same night and the next night, all I did was underwrite and underwrite more and go retour all of my comp properties, put my stuff together. And I knew the listing broker who was offering this property. And I know generally whatever whisper they say, I know it's going to go for at least $1 million above that. So I already started with that in mind, saying I need to underwrite it for a much higher price than what it's offered for. And I need to come strong. So of course, I had several offline conversations with the brokers, but when we went in, me and my partner, when we went in and made the first LOI offer, we were the highest. And some people might say, are you overpaying for this property, right? And that's a very valid question. But if you can come up with a way of assessing the potential of the property that you can still return money to your investors with confidence, you've run the property before, your property management company with whom I had a partnership for over 2 years now told me that they could meet all of those numbers, right, that I put in there for projections. That's mainly your rents, your expenses, payroll, those kind of things. If the budget that you come up with and the property management company agrees with you and you've partnered with them before, those were all some of the things that gave me the confidence that, yeah, this property is worth this much, right? So again, when I went into best and final and then the interview round, I could speak with confidence knowing what I was doing. And sure enough, when the appraisal came back, it was appraised for about 200K more than what we paid for. And we're already getting pro forma rents on all new leases and 3 weeks into ownership. So again, it's a matter of really knowing what you're doing. And so I, instead of trying to be a jack of all trades, I try to focus and say, this is my market. All I do is multifamily. Some people might be attracted to, self-storage and I don't know, mobile home parks and retail and, oh, let's do mixed use, let's do new construction. No, for me, it's a little box. And that little box is multifamily. It's going to be about this size. I need to see about this much in value to be able to syndicate it. It's different when it's a JV and it's just 2 or 3 of you having those conversations. It's very different when you owe investors. And that's why being a passive is so important, because you know what it's like to trust your money to somebody else and that feeling of, okay, I'm not in control here. I mean, the stock market is something we all do as a default, so we don't realize it. But when you actually, invest passively with someone else, it's like you're giving up control and you're hoping that they do a good job and return your money and provide you the same return. So I think it's important to go through that before you go and syndicate your own deal, because then you don't have the same feeling of empathy and respect for their money, so to speak. So I want to only invest even passively on the occasional basis with people who also invest passively, because if they've never invested passively before, they don't know what it's like to lose control. But as going back to my most recent deal, a lot of that upfront work and coming in strong right from the beginning and being serious right from the beginning, having that regular conversations with the broker to let them know how badly and serious you are about this property. I mean, you have to meet the price pretty clearly, but beyond that, if there's 10 people all willing to pay about the same price, how do you differentiate, right? And that's how you get awarded the deal. And then you make sure you have your capital partners lined up, because don't go make offers on deals without having the capital lined up. So start having conversations today with your capital partners. I'm going after, I don't know, a $10 million deal. I need to be able to raise $3 to $4 million, right? And if I can only raise 500,000 on my own, I need to find a strong capital partners who can cover that gap, right? So make sure you have those lined up and manage expectations up front with partners. Don't have surprises after the deal is closed. Write out what each person's role is and how you divvy up the work. So there's no surprises and who's in charge, right? Have your agreement well written out between partners to avoid any future misunderstandings.
Sage advice. And one thing I want to underscore is knowing your market. That's a theme that I hear throughout that. You knew this market well enough that, immediately over a long night of underwriting, you already are able to find your comps. You're able to understand about where this thing ought to be. And when you're talking about DFW, right? This is huge. This is giant. You got submarkets, you got neighborhoods. And what would you suggest is a good way for people to get that level of detailed knowledge?
I think if you're in a location where the market is great, like good old Phoenix, Atlanta, Dallas, etc., start really knowing those submarkets. Every time you drive, somewhere to run some errands, going to work, etc., figure out what's great about each market. Don't just trust the reports. Like there's Neighborhood Scout, there's CoStar reports, etc. All of those are good. And Neil Bauer has a really good podcast on just analyzing markets, and specifically what are all your free data sources to help you compile that together. So definitely put that together. And so if a property doesn't pass my location test, I don't waste any time trying to underwrite it. So my first screening is location and crime, right? So crime is so important. These are the things you can never change in real estate. It's location, 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 right? You cannot move the property. You cannot suddenly change it from a high crime area to a very safe area in a short amount of time, right? It's going to take you a while to do it. I'm not saying you can't do it, but it's a lot of heavy lifting involved in it, right? And you can't control what's happening within a 1 mile radius of the property. So pick one where, it's a low hanging fruit, you get tailwinds, everyone wants to move there rather than moving away from it, etc. So there is no substitute for actually being there in person. So if you're not the one who's going to be there in person, but that's a market you want to get into, find someone who is there, or find a way to make business trips, et cetera, periodically to get your own feel for that area. So visit the brokers by day, but drive around these neighborhoods at night, right? Have a plan, a 3-4 day trip to this location lined up, and do that at least every couple of months, because the climate changes and you need to know how this place is in the winter. Like we had a snowmageddon in Dallas, right? And a lot of us suffered from damage to properties from that. So know what happens during spring, summer, winter months in those locations, because a lot of your deferred maintenance, a lot of the way you can underwrite and things that you want to add value to the property vary depending on the location and the weather and the things that are normal in those areas. Like if you've always lived in California or Canada for that matter, and you want to get into a Phoenix market, I mean, you really need to know a local expert. So that's a gap. So look for people with complementary skills who can cover the gaps in your partnership.
That is awesome. And I love the element of triage, right? It takes a lot of time to run the numbers, takes a lot of creativity to go through there and figure out what a property might actually be worth. And yet, if you are able to start from the very start and determine if the area even suits you, or if the area is on the up, perfect. You can get rid of a lot already like that. So I know that another thing, and something you have mentioned, in addition to being an active investor, and congratulations on a lot of things you're doing, sounds really exciting. Oh, actually, before I ask you about passive investing, tell us a little bit more about DFW. I know this is a super hot market. A lot of people who are taking that sort of location-based approach, looking for places that are growing. They're investing in Texas and specifically in DFW. So where do you see the market headed?
DFW is going to continue strong. So if you have money and you want to put it into apartments, DFW is a great market to put into apartments right now. In 2020, through COVID, about 40% fewer new construction development projects for apartments were approved compared to the same time in 2019. So by the end of 2022, 2023, what you're going to see is a shortage, right? So you're going to have 40% fewer apartments ready in terms of new builds at that time. But what's happening with the population? It's increasing. There's just more and more people, more and more jobs moving to this area. And so for every job, I think you need what, a dozen other support functions, right? Whether it's your restaurants and retail and grocery and, you know, dry cleaning and nails and all of those other service industry, right? To support the movement of jobs. So you're having an increase in population, increase in job growth, but then you're having a decrease in supply. So and then prices are going up. You've heard the stories about single family homes, right? People want to make offers, you know, well above the asking price on single family. And there's 50 offers on the table for one property. So there's 49 people without a home, right? Out of those 50, one person got the deal. So your demand for apartments is going up. Lifestyle changes also, like millennials, retirees, et cetera, don't want to live in and manage a single family home with a yard, et cetera, by themselves. And the supply is not as high to meet that demand. So you are like creating the perfect storm here in Dallas. Rents are going up organically without even having to do a lot of elaborate upgrades. That's what we're seeing. My property that we bought 2 years ago, we were hoping to sell it and make a 70% overall return to investors in 5 years. Now, we executed the business plan, everything worked out nicely, but definitely the market also has to do with why in 2 years, I'm selling it for over 100% return, right, to investors. There's a reason for that. And it's not just because we're the most amazing operators on earth. I mean, we definitely executed the business plan, but definitely the market also had something to do with it. And I think that's going to continue. I think 2 years from today, a property you buy today in a good location, good submarket, low crime, et cetera, is going to be worth more in 2 years in Dallas, assuming you operate it efficiently, you're having a plan to address your delinquencies, and you've got your expenses under control, and you've got people focused on asset management, right? A lot of people want to just be on stage and hold the microphone. It's a ton of people behind the scenes who've made that happen. So asset management is a little bit like that. It's the less glamorous part, but if you execute it correctly, that's where you're going to return value to investors and to yourself if you're, thinking of a JV project. So if you ignore the asset management and completely leave it to a property management company, it's not going to be the same. So I'm very bullish on the DFW, I guess, in conclusion.
Awesome. And then for those that may be interested in investing with you, do you favor heavy repositions, or are you looking at some more lighter value add?
I'm looking for stabilized, a little bit of light to medium value adds to where there's still plenty of potential to add value to the residents. The tenants who stay in our properties, they're also our customers. And if we take care of them and we add value in ways that they're willing to pay for, other income sources is a big piece of it. But that's the way I look at a property. Like the property we just acquired 3 weeks ago, everyone thinks of doing interior upgrades, right? Oh, let's go put $5,000, $6,000 and make an ordinary apartment that hasn't been upgraded in a while look like a palace with granite countertops and premium appliances. Well, first of all, the apartment has to be vacant for you to go and do those kind of upgrades. So if you're 95% occupied, where's your opportunity to do that? So that's where it's going to be one at a time. It's going to be slow. It's going to take you over a year to upgrade every apartment at a minimum. And then you have the downtime of 5 to 10 days at a minimum to go and do those level of upgrades. And so you're spending $5,000, $6,000 for maybe a $75 rent bump, right? And the tenant is kind of like, this house is fine. This apartment is just fine by me. I don't need a stainless steel appliance and I don't want to pay you $75 more for it, right? So instead we looked at it as, what about laundry? You're spending $3 per load of laundry. What if I added the washer dryers in your apartment itself? Then you wouldn't have to leave in this hot summer day or cold winter day to go do it. And it's something I could easily do while you're still living there. I don't have to wait for you to vacate the apartment to do it. And so I'm just taking that laundry money that goes into the coin laundry machine and instead putting it as part of my rent, as an example. Then other income sources would be things like Wi-Fi. Everyone watches Netflix, whether or not they work on their jobs that require the Wi-Fi, right? So that's a monthly expense that most of our residents incur anyway. So that's an easy way for you to get that money repositioned from that internet company instead to yourself by providing Wi-Fi as part of the apartment. So these are examples of things you can do while a resident is still staying in the apartment. So I call them lighter value add things that you can continue to do instead of major renovations that require taking occupancy down to a low number and then increasing it.
Have you been able to do anything more exotic, like cell phone towers or maybe self-storage?
I have not done the cell phone towers yet. I am definitely looking at having our own Wi-Fi on property, but not done that, not scoped that. In terms of self-storage, that's going to be like, depending on, we certainly have the land for it in one of our recent properties. We looked at it for another property. It's going to be its own separate project. You're going to have to get separate funding for it, bids for it, et cetera, and zoning, et cetera. So it's, again, a larger undertaking in terms of effort for the increase in value that you might get from it. How many people are going to rent and actually pay that fee every month? And just see the proximity of your property to other self-storage facilities and whether it makes sense. But definitely going for the low-hanging, easy fruit, like laundry and Wi-Fi types of things that people will pay for. Parking is something a lot of people assume in their underwriting. And I always do a tenant survey before I assume any increase in parking. So it's something I don't underwrite up front, but it's certainly something we do once we take over the property to say, who is interested in covered parking versus just a reserved parking? And you won't know that until you're taken over and you're in the property for a little while to see what the market will bear.
That's some great and exciting wisdom. So I see you're about to go full cycle on a deal in 2 years with a 2x equity mult, all very exciting. But you also have, as I understand, 17 passive investments. And I'd like you to tell us a little bit about what you've learned and how you can help other people who are interested in coming in on the passive side.
So the passive side, the easiest part is once you're like a passenger on a plane, you trust the pilot, you buy your ticket, you know your route, etc. You've done that upfront homework, and you get seated and enjoy the ride with the occasional, reports from your captain. So that's your captain is basically the syndicator who you're trusting your money to. So vet them very well. No one on social media is ever going to say that they're not anything but perfect. So you got to dig deeper. You have to do your homework, just like you did for the last appliance you bought. So ask them for a list of properties they have owned and how have they performed. See if they can give you a reference of a passive investor whom you can speak with on every one of those properties, because they will give you the true story from a passive investor's perspective. No syndicator is going to tell you, oh, I did horribly bad in these 3 properties, and thankfully the market appreciated, so I was able to sell it and return money to my investors. No one's going to tell you that. They're going to say, oh my God, I waved my magic wand and I did this and I did that, and that's how I made money. So you can't hear from just the syndicator and then invest your money. You've got to have references of passive investors. Just like before you hire a contractor, someone's probably going to tell you your neighbor or friend referred you to that contractor. Same philosophy. You need a passive investor's reference before you invest for the syndicator. That's my number one piece of advice. Their track record of actual asset management, because most people you hear from on the marketing front are all capital raisers. A lot of them raise capital for a deal and then they're gone. Once the deal is closed, you will never hear from them again because they're not really running the asset. So you need to figure out who is the asset manager, who's going to stay with you from when the deal closes all the way to the end when the deal sells, right? So that is when you, the passive investor, who's going to stay with you, the passive investor, from when the deal closes till it's sold? The asset manager, who's going to run the property. What is their track record? Is there a property management company who's agreed to all the numbers? That's an important question to ask. So I have a set of questions to vet a deal sponsor that I can share with any of your listeners if they want to visit my website, which is multifamilyforyou.com, where it's multifamily number 4 YOU.com. And if they can visit that website and provide a name and email address, I can send them the checklist. It does not add them to my database or anything else. They will have to specifically have multiple conversations with me before they can invest passively with me, because I tend to do what is called 506B like Bravo syndications, which means you have to have a substantive relationship established before you can offer an investment. So getting my checklist does not add them to my database.
And for those of us that don't understand the terminology as well, tell us about that 506B exemption.
So this is by the SEC regulation that you could do a 506B like Bravo or 506C like Charlie. In a 506C like Charlie investment, it's a way of offering the investment to potential investors, because now you are raising money with the promise or the expectation that they're going to make money from this investment, just like a stock. So you have to comply with SEC rules for that. And to be able to advertise your deal, share it with people you don't know, etc., they have to be what is called accredited investors, for whom there is a specific definition, which is you need to have a net worth of at least $1 million, excluding your primary residence, or you have to make at least $200,000 a year in income as an individual, etc. So you can look up that definition. So unless people know you well, they can't ask you to invest in their 506B like Bravo deal.
And so tell us your definition of a substantive relationship.
For me, they need to have had multiple conversations with me to where I understand their level of sophistication and understanding of the risks involved in these types of investment. Every investment carries a risk. So if it's the last $50,000 they have in their savings, I definitely don't want that money in my investment. I want them to have a large enough portfolio with enough money left to where their investment in my deal is a very small amount. And I don't get to find that out until I have multiple conversations with them. Ideally, meeting face-to-face is always great. We understand each other's, I need for them to understand the risks involved in the deal when things go wrong, etc. And also my general philosophy, how I invest. we need to have very detailed conversations first. And there's a lot of people who'll exchange business cards, and the next day you'll get an investment from them, opportunity from them. And I don't do that because, when the SEC comes back and does an audit, you want to be able to explain why and how you had this connection with this person to offer them, because all the deals I do are 506B. So in addition to multiple conversations, I recommend having a questionnaire filled out by them that helps you understand their expectation. What's most important to them, the passive investor, right? Is cash flow important? Is it from a retirement fund? And they're not as concerned about the cash flow now, but they want to have good appreciation later, or they want their capital preserved, et cetera, right? And what is their experience in other types of securities, stock market, or have they invested in real estate before, et cetera. So you have to do the education first if they've never invested before in real estate, and make sure they understand, like the first few months, the cash flow may be low, depending on what type of a deal it is, right? And they have to be okay with that, because real estate investments like this are illiquid. You don't get your money back, your principal back, for maybe 5 years, right? And so they have to read what is called a private placement memorandum very closely, and their subscription documents very closely, understand all of that. So this takes some time. If going from zero to investing in the first deal passively, for some people, it's just a matter of, oh, I know you well, so I'll invest with you. But I highly recommend getting educated on the risks and rewards associated with real estate.
Yeah, those are all excellent things to keep track of. I see you're very careful, and that's good. That's good for our industry, that people are being careful and staying within the law. And another thing, which I believe you touched on, maybe you'd like to go deeper, is that the deal really has to match the person. And, there are different ranges of risk and potential reward. I would say maybe on one end of the scale, you've got new construction and all the things you mentioned. You've got permitting. You've got to do really a different type of market research. You don't have anything in place yet, right? So have to ask the question, well, what would such a structure potentially bring? And then on the other hand, you've got stabilized properties. In the middle, you have the value add, where you're operating and where I think a lot of people are operating. I personally like the value add because I think it gives a great balance between that risk and reward.
Yeah, I like that too. And another thing to remember is with these investments, as I mentioned, is it's very illiquid, and especially something like new construction development deals. A lot of people who used to run multifamily properties are now going into new construction. You want to know who else is on their team with a prior background in construction. It's the you don't know what you don't know deal, right? So you want to know that you're working with someone who's done construction prior to this in terms of new development, and are very familiar with the zoning laws. They have already an established relationship with the local authorities in that city. Like, you might think a place that is 10 minutes from downtown Dallas just has to worry about the city of Dallas ordinances. But you might be in a little town like Cockrell Hill, which is only 10 minutes away, and the city of Cockrell Hill and how they do permits is completely different. And you need a permit for even putting up a sign that says under new management, or under new ownership in this property. So you need someone who knows local laws, and you need someone who has done the same thing before. It's like, I'm not going to be your scapegoat for your first brain surgery. Please have an experienced surgeon in the room if you're a resident or an intern trying to do the same brain surgery, right? Closely supervising this. So I think of real estate investing in that sense, that this is other people's money. It's a lot of money involved. It's not $25 worth of Girl Scout cookies or Boy Scout popcorn. We're talking $50,000 and more. You just can't afford to take chances. You got to treat that money with a lot of respect. It took someone a long time to earn that money, and they worked very hard for that money. So you can't be frivolous with it and take chances saying, I'm going to go try new things. Well, you go try new things on your own, but when it's other people's money, you go try new things only when you have an experienced partner showing you the way.
Now, I see that one of the things that you don't seem to like to take a hand in directly is the construction. So what is your secret for getting a great construction leader on each of your projects?
I have very minor construction projects involved, and I've learned a lot in the last 3 years of running properties. So one of the things we did in the first deal that is now completing a full cycle is we had to move the leasing office. The leasing office was actually one of our largest units, a 2-bedroom, 1.5 bath, and we had to move it. So when you employ a property management company, they usually also have a construction company or a supervisor. That's your main person that gets you bids. And when you get 3 different bids, you ask the questions of, okay, have you had experience with this contractor? Are they good about staying within their estimates? What are some unknowns that could happen in this project that could change my numbers? What about keeping on schedule, et cetera, right? So with every construction project, you learn something new. You learn, for example, that a city like Cleburne, which is 30 miles from Fort Worth, contractors are more reluctant to come there. You learn that now we're in August of 2021, it's very hard to find good labor. So sometimes you may have to pay a little more if you wanted someone to come that day to do something for you, like a plumber is impossible to find. Air conditioners are always in demand in this time of day. So it's very hard to get AC contractors, but you learn along the way. And right now I don't feel like I need help. I don't need someone with a lot of construction experience on my team because I've learned so much already and partnered on so many other projects at this phase. But if I was to do a new development somewhere, yes, I would need someone who's done that before, because that's not something I have done.
Excellent. And at this point, I would just like to ask if you'd like to turn the tables, if you have any questions for me.
Yes. What is your favorite part of multifamily? Why are you in it? Why are you interested in it?
So I like people, and for me, the most exciting thing is the capital raising. I like to be in investor relations. I've got my own meetup, and I find it very rewarding to educate people, to bring them along in the process, and to teach them what's essentially going on. And it is something that is very, I think, rewarding. You can get easily some very strong returns, and at the same time, enjoy or experience a fair bit less risk than you might in some more traditional investments like equities. So for me, it's the people aspect more than anything. But I am also interested in construction. Helped my sister launch a construction business. I'm interested in the acquisitions. The deal making is fascinating. But again, I think everybody finds that one thing that they like more than anything else. And for me, it's the investor relations.
That's a very interesting answer, that you love investor relations and educating people. Cool. A lot of people are like, oh, I just don't want to do the other work of asset managing. So I just want to raise capital and be done with the deal. So I really like your perspective. Do you have any favorite markets you like to invest in, and why?
Absolutely. Number one for me is Central Florida. I like it because it's growing like crazy.
Hmm.
It was hit by COVID. I made my first active investment as a joint venture partner almost exactly 1 year ago. That was August of 2020. And again, one of my favorites has got to be Warren Buffett. You look for a company that has solvable problems. Well, this pandemic was a solvable problem. In August, we didn't know that we were right around the corner with a vaccine. We also didn't know about the Delta variant and all the other things that have hit us. But again, we had no idea how close we were to the end of the pandemic, but we knew that certainly as people get moving around again, they're going to want to go out to Disney, they're going to want to go out to Universal, and that this area will rebound. So we took a little bit of a chance, we got a bit of a discount, and we are very much benefiting from that rebound right now.
That's excellent. That's excellent. So are you looking to do future projects also in that same area and build more on the relationships, et cetera, you have there?
Absolutely. And our whole leadership team is going to be back in Orlando in October. We do go there several times a year. I think your advice is spot on. You want to be there at least multiple times a year. I love the idea of being there every 2 months. I don't know that I
Mhm.
can keep that cadence up. But again, we're going to be out there to see Jake and Gino and to meet people again. And it's great. You know, we got our boots on the ground. We do have a lot going there and would love to get some more in that area. I also love Tampa. Tampa's a little tougher. Tampa is a little bit more like Southern Florida because your money goes hard right away. It's almost like Texas. A lot of people think like Florida, really? Your money going hard on day one. But yeah, Tampa is really tough to break into. But we have some connections out there. We're looking for deals. And I've got a great team at Horizon Multifamily. We've got partners in Tennessee and Colorado. So we have some pretty amazing reach across the country. But again, we are focused in the Sun Belt, but open to other areas as well.
That's awesome. And what made you start a podcast? What are you hoping to do? What's the purpose of your podcast?
Well, I think it's just literally sheer insanity. I've learned it's a lot easier to go out and become a guest on podcasts. For me, it had to be a labor of love to make this worthwhile. I wanted a different angle, and I love entrepreneurship. So I came from construction. I had been a landlord for many years, over a decade. Now a bit newer to multifamily, but again, building that up. And I'm just fascinated by the entrepreneurial journey, the entrepreneurial spirit. I love to hear about how other people got into entrepreneurship, what inspires them, their advice. I just, particularly, I got to say, during this COVID pandemic, it has been an amazing lifeline to be attached to entrepreneurs, to be able to talk to people like Damian Lupo and his tribe of honey badgers, and to be able to talk to people like Jamie Gruber, who has now 20 chapters of multifamily and more, and is out running part of GoBundance. He's got a couple programs that he started up over there. These sorts of people, we're at a time frame where I think the world has separated into two camps more than ever before. Some people are acting as victims and saying, how can this happen to me? And they're upset, locked in their own home to some degree or another. People are moving around now. And you've got people who are just seizing the day, who are looking for opportunity all over the place. And one of my favorite questions that I didn't get a chance to ask to you, I know we're running towards an hour now, is how people, handle the pandemic timeframe. And for me, it was just amazing. Everything that I've done, not everything, but it seems like just I 10x'd everything. So I went from helping to launch this construction company to having my first hard money loan, to having my first active investment, to having 2 passive investments in multifamily, and looking for that larger deal that I can syndicate. So it's just been a massive time of growth. And again, to have that sort of a lifetime is just amazing. And I wouldn't be in the same place without that. So for me, launching the podcast was all about loving the entrepreneurial journey and loving to share that with other people.
Fantastic. Well, that was very, very, very interesting to hear such a variety of reasons for starting a podcast. I've always wanted to start a podcast, but hesitated because of the consistency. But I think meetups seem a lot easier for me, and that's the way I'm headed. But maybe one day when I launch a podcast, you'll be among my guests.
I would love to do that. Call me when you do that. And thank you so much, Sandhya. Is there any other thing that you'd like to tell our listeners, for those of us not watching the video version, how they can get in touch with you, or anything you'd like to give us on the ride out?
Yeah, please visit my website, multifamilyforyou.com, where the 4 is a number 4 and it's YOU.com. And I can give you a free passive investors checklist on how to vet a sponsor. And it's certainly a place where you can send me a message if you want to get in touch with me and have any further conversations.
Well, thank you, Sandhya. This has been an extraordinarily informative interview. I want to thank you for taking the time to be our guest today. Thank you.
Thank you so much for the opportunity. We'll be in touch.